Good afternoon, ladies and gentlemen, and welcome to the 1 p.m. PLC final results investor presentation. Throughout this presentation, investors will be on listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of the screen. A box beneath that, simply type in your question and press send. If you're accessing this via a mobile device, the Q&A tab is situated below. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand over to Ian Smith, CEO, and James Roberts, CFO of 1 p.m. Good afternoon.
Good afternoon, everybody. Yes, it's Ian Smith here. Thank you very much for joining the presentation this afternoon. We're pleased to have the opportunity to provide you with an update on our results. It's important to us that we're able to update private shareholders and retail investors in the same way that we do our institutional investors. So thank you, Investor Meet Company. Thank you, Mark, for facilitating this. What we intend to do today is to provide you with a bit of background information on the company to bring you up to date, to set out the reasons why we think we are in a very robust and resilient position, to give you an overview of how we've addressed the COVID-19 situation and the impact on our business, and then obviously to talk you through the financial results for 31st of May 2020 that we announced earlier this week. And then towards the end, I'll also provide a few comments on our longer term strategy and short term outlook. So as I say, thank you very much for joining us. To give you a brief overview of 1 p.m. at a glance, make no apology for starting with the fact that we're a customer outcome-led business. We do genuinely focus on providing the best solution that we can for our clients. It's an important part of our cultural pillar to put our clients at the heart of everything we do. And we deliver a range of financial solutions to boost British business, and in particular the smaller end of the SME scale. And that organizes itself into 4 product divisions. So that's asset finance, providing business critical equipment for small businesses; invoice finance, which is really cash flow financing against a sales ledger; vehicle finance; and property and business loans. In terms of how the business has developed recently and the stage in our development that we've reached now, we are lending 123 million to UK businesses. We're generating 29 million of revenue. We originated 147 million of new business in the last 12 months. We're dealing with over 20,000 clients and small businesses. We generated 3 million of profit before tax and exceptional items, all from 179 people and working across 6 sites in the UK, and on the strength of a balance sheet that now has equity of over 55 million. We've got a well-respected and well-regarded position in the market, and have won some awards along the way. I'm very pleased and proud, in fact, to be leading an established and stable and dedicated management team. It's a diverse team in terms of gender, as you can see, in terms of age range, in terms of experience and expertise. Just a couple of minor highlights. I mean, Holly Mapstone, our head of HR, has been in the business since we were 13 employees and has helped grow it to where we are today. Lorraine Nayland, our head of risk, has had a career in financial services, in particular with Lloyds Bank. Jennifer Bodie, our head of compliance and governance, has been 17 years in the FCA. And Carol Roberts is known as the doyenne of the leasing industry. She's been in the leasing industry for 50 years, since the very early days of the industry. So a very stable, well-regarded and highly respected management team who have, I think, handled the circumstances of the last 12 months particularly well. And how we describe ourselves as a group: we are a non-bank specialist finance provider. The trading subsidiaries within our group that deal with regulated activities are FCA authorised. We operate a hybrid model, and that means that we're a lender on our own balance sheet, but also have the flexibility to broker business onto other funders. All of the lending that's on our balance sheet is to UK SMEs that meet our credit criteria. And so anything that's outside our credit criteria for business, or indeed any deals that are for consumers, we broke on to other funders. And as I mentioned, we're deliberately multi-product to provide all the products that we think smaller SMEs require. A couple of points in terms of our mission. Our purpose is to grow. I mean, we are here to grow together with our clients, adding scale and capability and products to everything we do. But crucially, in terms of our policies, we regard ourselves as a cautious finance provider. So although we want to grow, we don't want to grow indiscriminately. We want to grow by ensuring that we maintain our credit quality and maintain our margins. And we've been successfully able to do that over the past 12 months. To bring that to life, let me just talk you through some very recent deal examples. There's nothing particularly marquee about these. These are the kind of deals that we do on a day-to-day basis. So the asset finance example is where, for a food manufacturer, we've provided £77,000 worth of asset finance facility. But in this case, it's a good example of our broking and lending model. We've lent 50,000 on our own balance sheet and broked on 27,000 to another funder. So that's how we mitigate some risk. And in terms of invoice finance, the example is for a fashion and textile manufacturer that had a very recent contract with the NHS for PPE, and we were able to provide some cash flow funding to enable them to execute against that lucrative contract for them. And the business loan example is a special situation loan, as we call it, and very particular circumstances to this company. They had the opportunity to settle a franchise fee for a lump sum payment, and we were able to provide that lump sum payment through taking appropriate security over the client's assets. So very varied examples, and a snapshot of the kind of deals that we do on a regular basis. In terms of where we get our business from, we like to have a spread of introducers bringing us business, and this sets the introducer channels out by division. So in asset finance, the majority of our business comes from finance brokers and from equipment suppliers. The finance brokers tend to be different depending on whether it's soft assets or hard assets. And apologies if I'm telling you something you already know here, but a soft asset would be something like a coffee machine, as pictured in the graphic there, where there isn't really any value in that asset after a period of use. So the decision to provide credit to that business is much more about the affordability of the business to repay, as opposed to the intrinsic value of the asset. Whereas with a hard asset, which is typically sort of yellow plant, JCB diggers, for example, the decision to lend is tied up much more in the value of the asset itself, where there is a resale value for that particular asset after a period of use. So our leasing can be soft or hard assets, and that tends to come from finance brokers and indeed equipment suppliers. And this is where original equipment manufacturers or resellers or distributors will have customers who want to buy product on credit, and they will point those customers to us to provide the credit agreement. This year, we're also introducing a direct channel, so going direct to companies to sell our finance products, and we'll increasingly be doing more work digitally, i.e. Transacting online in the future. And it's similar across the other divisions. So our loans business comes from residential and commercial mortgage brokers, and from finance brokers, accountants and corporate finance firms. In invoice finance, it's similar. Professional firms and insolvency practitioners, some national but mostly local to where we operate, and occasionally bank referrals. And then our vehicle finance deals, all of which are broked on, as I mentioned, tend to come from used and new car dealers, and indeed fleet customers, and indeed individual borrowers online. So a broad spread and a broad range of introduction channel is where we receive our business from, and that is important as being one of the elements that create a very robust and resilient platform. Risk mitigating spread is something that we like in everything we do. So spread in terms of introducer channel, asset category, lending product, etc. The next factor is the operating model flexibility, as I've mentioned, to be a lender and a broker. We also see in our end of the SME market a very high degree of borrower resilience. We're typically lending to independent businesses for business critical equipment, and those businesses are making staple diet consumer products. We typically don't lend to multiple outlet retail chains or multiple restaurant chains, for example. It tends to be the owner managed businesses, and there is a high degree of borrower resilience in those companies, because if they don't keep up their payments for their business critical equipment, then they don't have a business. So that leads to lots of small individual exposures, which we like, and we take security against every deal that we do, even if it's as simple as a personal guarantee. If a deal does go bad, we're very adept at leveraging that personal guarantee instrument to recover our money, and we'll talk a bit more about that as we get into the detail of the numbers. All of our underwriting is done by people. We're not reliant on algorithms, and this has particularly come to the fore in the last few months of COVID-19. I don't believe there is a artificially intelligent pattern recognition algorithm anywhere in the world that could have predicted the nuances of customers' particular circumstances during COVID. So having people doing the underwriting and making the credit decisions has come to the fore as being a key factor in our business model. We believe we're very cautious. We have impairment provisions that are now in excess, quite significantly in excess of what the IFRS 9 accounting standards say that we should require. And certainly our provisions are in excess of our annual write-offs. All the deals that we do are fixed interest rate. Once we've written a piece of business and borrowed some money, the interest rate is fixed, so we're not subject to changes in interest rates. And all of that is on the back of a strong balance sheet. We have 27 million of net tangible assets and comfortable headroom in our gearing covenants from very supportive funding partners who provide us with ample operational debt facilities, which will enable to grow as we go forward. And James will explain a bit more about that shortly. So all in all, a very robust and resilient platform, but I guess we can't really go any further without talking about COVID-19 and our response to it. We formed an incident management team very early on in the process. In March, we set out 4 guiding principles that you can see there. Clearly a focus on the health of our employees, importantly an uninterrupted seamless service whilst remote working, unwavering support to our existing borrowers in the form of forbearance, and we'll give you some up-to-date data on that shortly. And crucially, remaining open for new business to support creditworthy customers during this period. And I'm pleased to say that we've been able to adhere to each of those guiding principles. And I suppose COVID itself has impacted us in 3 key ways. The first is its effect on our own trading. And certainly in Q4 of the year, we found that our origination and our revenue generation and our cash flows were adversely impacted. And what we were able to do there is to leverage our strong bank relationships and our strong balance sheet, and to take out our own 3.1 million term loan arranged through NatWest to offset the negative aspects of the COVID-19 impact. Secondly, in terms of the effect on our borrowing portfolio, we felt it was right and proper to be able to provide forbearance to our existing borrowers. And what that means is some form of payment reduction or payment holiday for a period of time. And we've managed that internally. We've done that through our own cash flows, which crucially means that we haven't had to go back to our funders to ask for similar forbearance from them. And that in turn has allowed us to keep our doors open, as it were, to continue to lend. And that's the third impact on our business. We have been able to continue to lend during the COVID crisis. And crucially, very early on, we decided to leverage our strong relationship with the British Business Bank, with whom we already had a facility, to be able to become an accredited lender under the Coronavirus Business Interruption Loan Scheme, CBILS. And we were allocated a facility of around 7 million to lend with the benefit of an 80% government guarantee. The coronavirus, the CBILS scheme ended on, it was due to end on the 30th of September. As of yesterday, it's been extended, but we were due to be able to lend 7 million up to the end of September, and we were bang on track to be able to do that. And now that the scheme has been extended, we'll be applying for a further allocation to be able to continue to lend under that scheme and with the benefit of a government guarantee in the background. So I think overall we've handled the COVID situation and the impact of COVID on our business extremely well, but it has contributed to the numbers that we've reported this year. And on that note, I'll hand over to James to talk you through the numbers, both at a high level and indeed to get into some granular detail on latest developments. James.
Thanks, Ian. As Ian said, COVID really has impacted these numbers. Our year end is to the end of May, and so obviously the final quarter, March, April and May, was right at the height of the COVID issues, and so that impacted the numbers. One point to draw out is that up to the end of February, or the first 3 quarters, we were trading pretty much where we thought we'd be, but the negative figures you'll see on the right-hand column are driven purely by that final fourth quarter drop-off in business. Looking at some of the key lines, our deal origination fell. Again, that's because of COVID. And by deal origination, what I mean by that is those are deals that come across our desk and we either write on our own book if they meet our credit criteria and pricing, or we broke them on if maybe the margins are too thin for us, or they're not of the credit quality we'd like. So that is really the lifeblood of the business. So although it has fallen, it is still significant origination. And crucially, the green shoots of recovery experienced in Q1 since this year end, those figures are coming back up to levels we experienced previously. So that's pleasing. But the origination was down, and that contributed to the revenue falling. So revenue is down by a similar amount to just over 29 million for the year. And if you take that fall in revenue and the increase in the bad debt provision, which you'll see is the final bullet point, and I'll talk about the bad debt provisioning in a bit more detail on a future slide. But the increase in bad debt provision that we put in place to, we think, cautiously and prudently mitigate for any potential future impact of COVID in the coming months, it saw that combined with the revenue, saw the profit before tax and exceptional items fall to a level of 3 million. So significantly down, but purely driven by the impact of COVID, both on a lower revenue and increased provisions. Crucially, though, we remain profitable and cash generative throughout. Some other key things to draw out are operating expenses. They have fallen during the period, and that was partly due to the fact that, again, as a result of COVID, we decided to cut our cloth, if you like, and rebase our cost base for the world we find ourselves operating in. So the effects of those changes we've made will be experienced more in the current financial year, but there was some impact in the period to 31st of May 2020. Our net assets continue to grow. So as I said, despite the COVID turmoil, the business remained profitable, and our net assets increased to over 55 million, and our net tangible assets are over 27 million. And the two penultimate bullet points are quite key ones, I think, for us anyway, and a sort of source of pride, really. We are primarily an own book lender. We are a broker as well, but we're primarily an own book lender. And we'll talk about the funders and the borrowers we've got in place. But crucially, they have all been very supportive throughout this period. And where they've maybe tightened their facilities or even frozen facilities and increased rates because of increased risks to other funders in our boat, with us, because of the strength of the relationship and the high regard we think they hold us in, they've maintained the rates they charge us have been pretty static. So you can see the blended cost of borrowing throughout the period remained flat at 4%. And our funding facilities have been renewed, even extended during this period, meaning we're primed for growth as and when the economy allows it in the near future, hopefully. We then have some new slides to those of who we presented to before coming up now. There's 4 slides, one per each of our trading divisions. So that's asset, invoice, finance, loans, and vehicles. 2 reasons for that. This is the first year in our statutory accounts we've included segmental analysis, which obviously has some detailed notes on how the individual entities have traded. And secondly, because a number of investors and potential investors have said to us before they'd like to understand better each of the four divisions. So if we start with asset finance here, this is really in a microcosm the same message I said for the overall group. It is our largest division, and so it has driven the overall group performance significantly. So the story is very similar there. If we start in the top left-hand corner, you'll see the blue lines, which are the year to May 20, are lower than the orange lines, which were the year before, and this is deal origination. So deal origination, again, because of COVID in Q4, reduced during the period, so we can see it's down from 54 million to 41. as I touched on, the Q1 is showing the green shoots of recovery. So this period to 31st of May, this snapshot at 31st of May very much is the low point. If we move around in a clockwise direction, we can see the split of own book versus broked on, and this is quite a key one for us. If possible, we get the right deals coming across our desk, and we can write them on our own book, we will. If the pricing's right and the credit's right, then we'll write them on our own book. And the reason for that is that over the length of the lease, which can be anything from 3 months to 5 years, but invariably around 3 years, we will earn a lot more profit from an own book deal than a broked on deal. Broked on is fine for short-term cash and profit generation, but over the longer term, on your own book is more profitable. So we will put, if it's the right quality and the right price, on our own book. So moving more towards a higher percentage of own book, we think is a good thing for future growth. And it shows that the marketing messaging and the relationships with the brokers, high-quality salespeople we're bringing on board are getting those messages out there, and we're seeing ever more. And that's continued into Q1 in the current financial year of deals coming across that we're able to write on our own book. So that's quite a key stat and quite a pleasing one for us. As we move down, we've got the portfolio there. So this shows the portfolio has fallen, as we'd expect. Two reasons for that, and this is actually reflective across the wider group, is one is, as I touched on, the origination has reduced in Q4. So that meant that the new deals coming on were lower than the repayments and capital interest and capital repayments we were making. So the book began to fall. But crucially, a second point is that there was a conscious decision from us to point deals that we thought were in particular difficulty and we didn't think we'd be able to help, that were on our book, towards other forms of finance, such as the government-backed bounce-back loans, etc. So we effectively de-risked our book by taking some of those out of our book and pushing them onto bounce-back loans elsewhere. So the fall was exacerbated by that risk mitigation tool, which we think was the right thing to do. Coming to the bottom right-hand corner, bad debt provision, obviously a key one for us. So we can see here the bad debt provision in the asset division increased significantly. We felt it had the greatest risk profile and was impacted the most by COVID. So we took the opportunity to increase the bad debt provision. We hadn't seen, crucially, any increase in write-offs or liquidations or anything like that, but we felt that it was the right time to increase the provisions, because looking forward into the future, it could be that there could be an increase in write-offs at that stage, and we wanted to be ahead of the game. So we increased the provision prudently, even cautiously, some might say, to look forward into the future, which we thought was the right thing to do. But all of that's fed through into the profit and loss on the bottom left-hand corner. We can see there the revenue reduced again because of COVID in Q4. Gross profit fell as well, again, because of COVID in Q4 and the increase in the bad debt provision. And that's rolled through to a profit before tax significantly lower than the year before within our asset division. The crucial thing there, though, is that this bad debt provision, and apologies to labour the point, but the increase in the bad debt provision is us looking forward to the impact we think might happen over COVID over the next 6 to 12 and beyond months. So that big increase of over 2 million in bad debt provision really is a one-off. It's not a statutory exceptional item, but it's a one-off. So if that won't be there next year, and then the division is profitable in the millions again. So the fact it remained profitable is good, and without that bad debt provision, as we move forward, it will be significantly more profitable. Similar set of graphics here for the invoice finance division. Slightly different story though, because of the nature of the nature of the business. We can see here the origination actually increased during the year. And that's because origination in invoice finance is calculated in a slightly different way. In asset and loans, it's the individual deal. Someone comes to us for a £50,000 lend. Invoice finance, however, is the size of the facility we grant to people. So we could be granting a £500,000 facility, but they may only draw 200, 300,000, 100,000 of it even. So there were an increase in new clients, an increase in facilities made during the period. So that origination figure has gone up. But as you can see on the top right-hand column, the portfolio for invoice finance, the amount we've actually lent has gone down. And again, that's because of COVID in Q4, whereby people weren't utilising those facilities as much as they had in the past. So slightly different story on origination because of the nature of invoice finance and the fact it's a facility rather than a specific, for example, £50,000 deal. But the portfolio is the same story. Q4 reduction as people weren't utilising the facilities as much. Having said that, we did increase the bad debt provision because of the nature of invoice finance and the fact we have control of the entire debtor book and are advancing a relatively small sum. The invoice finance bad debt provision is far lower, but in real terms there we have effectively doubled it in the period, but in monetary terms it's not a huge increase. And it's that change in the bad debt provision not being huge that you can see on the left-hand side meant that the invoice finance division remained relatively profitable, similar to the year before, slightly lower, but not significantly lower, and that's because of the fact that the bad debt provision was only marginally increased in real terms. The third slide is loans. As Ian mentioned, we have two types of loans here. We have personal property-backed loans, which we broke on. These are for second charge mortgages, etc. And we also have our own book lending arm as well, which will do special situations or small working capital loans. We can see here the brokerage arm origination increased during the period. That's despite the brokerage really retracting in Q4. It advanced a significant number of increased deals during the first three quarters of the year. The own book loans stayed relatively static. Again, a very quiet fourth quarter, but it had been going well ahead of expectations for the first 3 quarters. We've got a similar story in the top right-hand graphic, though. We can see that the portfolio for the own book, and this is the own book loans here, fell from just under 10 million to just under 8 million. Again, purely driven by COVID, combination of lower origination and a combination of us de-risking the book by pointing certain clients towards bounce back loans and what have you. Bottom right-hand graphic, again, it's the bad debt provision. We see an increase here, relatively percentage-wise, relatively high one. However, again, in terms of monetary, it's relatively small given the smaller nature of the loan division, but a similar story and message behind it. And then in the profit and loss account on the left-hand side, we can see the division did remain profitable, but because of that increase in bad debt provision and the lower origination and revenue in the final quarter, it was marginally so and down on the year before. Vehicles, our fourth and final division, is different. It is not an own book lender. We like vehicles. They're a good source of profit and cash, but we broke on purely those deals. So it's purely brokerage, this one here. And it's actually got a pretty good performance compared to the year before in terms of origination and number of vehicles supplied. They really were flying until COVID hit. Once COVID hit, the vehicle division effectively had to close its doors because dealers and the like had their doors closed. So there was very little of anything coming in the final quarter. However, the first 3 quarters really were going good guns. And as I say, the green shoots of recovery are there in Q1. The dealers have opened their doors again, and we're seeing a return towards the levels we experienced before. But what that did mean, that final quarter where the doors were closed, the vehicles division really didn't earn hardly any revenue at all. And so it was marginally loss-making for the period in question. That now, as I say, has changed. We've hit the low points and we're on the road to recovery there. One of the key strengths we think in the group, and Ian and I have said this for a number of years now, and I think the COVID events have borne it to be true, is the spread and the diversification of the group. We pride ourselves on doing a number of small deals in a variety of sectors. And what this graph here is showing is that if we take the left-hand side, it's a bar chart showing the value of the deals we have out per sector, and on the right-hand side, the pie chart is showing the number of deals we have per sector. So just to give you an example, you can see the largest slice of the pie, just over 11% in terms of number of deals, is unlicensed restaurants, but in terms of the value of those deals, the green bar in the middle at just over 3% is the value of the unlicensed restaurants. So you can see there's a significant number of small ticket deals in that aspect. Crucially for us on the bar graph, the key one, no one sector is over 6.5% of the overall lending book. And once you get to the second sector, they're all below 5%. When we're down to the 10th sector, it's just over 2%. And what you can imagine is a tale of dozens and dozens of sectors reducing over time as we move out. So you can see that that one sector could struggle, and in this black swan event we've suffered over the last 6 months, a number of sectors could suffer. But because we are not exposed materially to any one sector, well, it's a pain and difficult. The robustness of the business stands through, and we were able to trade through it, which we have done profitably. I've said it earlier, we are primarily an own book lender. We do broke on, it's about 20% of our revenues, but primarily we are an own book lender, so the portfolio is a key thing. This is quite a busy slide, so if you bear with me just while I try and draw some key points out on it. On the top left-hand side, we can see the value of the actual lending book that we had at the 31st of May 2020. You'll see there gross receivables of 123 million, net portfolio of about 108. That's down on the year before, as I said, two reasons. Origination fell off in Q4 because of COVID, and we took the opportunity to de-risk the book by suggesting people take advantage of bounce back loans and things like that. So together that meant the book fell from about 142 at the end of May 19 to about 123 at the end of May 20. The middle points there split that 123 out into up to date and in arrears. And by that, what we mean by up to date is 104.7 million of that book was working exactly as we thought. They paid every penny of interest. They paid every penny of capital. It was hunky-dory, for want of a better expression. But you could see there is 18 million of that book, or about 15%, that were in some form of arrears. Now that could be a day late, maybe because of a failure of the direct debit or what have you, through to 90 days or 120 days. Crucially, with that figure, at the 30th of August, 9 million or 50% of that 18 million is now back on track and working as we'd expected. So we're working through the others, but that shows that figure has come down significantly as the credit team have begun working on I suppose, the low point of everything at the 31st of May and the height of the COVID issues. As we touched on earlier, we have increased the bad debt provision relatively materially from 2.4 million to 5.1 million. We feel that's the right thing to do in the current environment, and it positions us to, if things worsened going forward, we have adequate provisions there to more than cover that, we believe. The sentence at the bottom left-hand corner is quite a key one, I think, and again shows, I think, the resilience of the group. What we've found of where deals have been written off, and we've unfortunately had to try and recover them by other means, in legal or anything like that, over the last 4 or 5 years, we've been consistently, due to the small nature of the deals we do, been recovering about 75% of the amount we write off. And crucially, between March and September now, every month in that 6-month period, we've seen that maintained. So despite the wider COVID issues, we are still, because of the nature of the model, able to recover between 70 and 80% each month of the amounts we write off. And that's quite a key thing for us and gives us comfort that the level of provisioning is prudent, even cautious. And the reason for that is because our average deal size is sub £10,000, and by hook or by crook, if people have, if it gets to this at risk of bankruptcy, they tend to be able to repay somehow 5,000, 4,000, 6,000, whatever. And so, so the PG on these deals really does lead to a good recovery rate. The right-hand side shows the forbearance. So by forbearance, this is us giving some kind of reduced payment to our clients. We can see here that since COVID hit, roughly 2,000 clients requested forbearance. We've granted just over 60% or 1,200 or so of those requests. The reasons for some we wouldn't have granted is some people were chancing their arm. They're very, very successful businesses that really didn't need forbearance, and it's not our place to give forbearance where it's not needed. And other ones, we were concerned that maybe we'd just be delaying issues, and so those are the ones we recommended and pushed towards bounce back loans and have you and de-risk the book, as I touched on. What you can see there, though, is the significant spike in Q4 FY20 as people requested forbearance at the beginning of the COVID crisis, compared to Q1 of this financial year, where really now people have sort of come through that and can see light at the end of the tunnel. And so the requests we're receiving now are very, very few and far between. What that means in terms of value is that roughly 31 million of our deals have had some form of forbearance. And the crucial thing here is we haven't got 31 million of our book sitting there not paying us. What we've done is offered them one of 3 or 4 different scenarios. They could have no interest payments for 2 or 3 months. They could have 50% payments for 2 or 3 months. Or they could have no payments for 2 or 3 months. They couldn't sit there for 6 months and not pay us anything. And every one of those people in forbearance there is sticking to those new plans. And what that means in a cash point, which is quite key, we think, down in the bottom right-hand side, is The impact of giving forbearance has only been 1.1 million of reduced cash received than we would be expecting in the normal course of business. On the flip side, pointing clients to bounce back loans elsewhere, etc., has meant we've received 1.5 million of cash in, more than we would have done in the period. So the net effect of forbearance and settlements is actually we're about £400,000 stronger in a cash position through this crisis, which we think is a very good outcome. I mentioned the spread and diversification being a key pillar of the group. We think funding is another key strength. We have a number of key funding partners who've been very supportive, worked with us for a number of years, the likes of NatWest, the British Business Bank, Aldermore, Siemens, Hitachi and Investec. We have over 10 million facilities with all of those. We have a 35 million facility with the British Business Bank in particular. And those guys fund our distinct divisions. So the block funding line, 105 million there, that funds the asset division, which is both hard and soft assets. The fact we've got significant headroom, we think, is a good thing. It means we're primed and ready to go for growth as and when it comes back. And crucially, we pay no non-utilisation fee for those facilities. So they're a very good thing to have, and we appreciate the support we have from our funding partners. Our loans division is funded by a secured medium-term loan note programme, which again has significant funding power as the market picks up. And our invoice finance division is funded by a back-to-back facility of 42 million with NatWest. So we've got a number of significant funding partners there. They've maintained their rates at a similar level for us, which is great, and they've renewed or extended facilities for us. So as and when things come back to normal, and I'm sure Ian will talk about it, we think the competition will be far less and the opportunities far greater. We have the firepower to take advantage of that as that materialises. Just a couple more quick slides from me. Ian mentioned it. We were accredited as a CBILS lender in May, and we began lending in June. We had a 7 million facility with the British Business Bank to lend CBILS loans by the end of September, and we're on course to have done that almost to the penny in the next couple of weeks. As Ian alluded to, only 48 hours ago, that CBILS scheme was extended for another month or so. And so we have got the nod and the wink from the BBB that we'll be able to extend our facility if needed. So this is a great source of new origination for us, another product to offer to people. It makes us very competitive. And crucially, we haven't used this as a race to the bottom in terms of rate or in terms of credit quality. We've maintained our rates and we've maintained our strict underwriting policy. So we're getting what we think is correctly priced, good quality deals, but now with an 80% backing guarantee from the government. And so we're delighted to still be able to lend CBILS for another month or so. The final slide then from me before I hand back to Ian, just some key KPIs and the balance sheet. We've mentioned the fact that despite this storm and the 31st of May being very much the bottom of the issue, as we recover well in Q1 this financial year, we saw our equity, our balance sheet strengthen to over 55 million, of which over 27 million of that is net tangible assets touched on. During all this period of turmoil, our cash has strengthened. We've always been relatively cash light as we look to lend out, but we have seen our cash increase from over 1 million to over 2.3 million. We've maintained our net interest margin, which is the difference between what we get funds in at and we lend them out at. So we still have a healthy margin of 12%. And crucially for some shareholders, the dividend point at the bottom. Some shareholders don't want us to pay a dividend. They want us to invest for growth. Other shareholders do want us to pay dividends. We had a progressive dividend policy we announced 2 years ago that we'd been following through. We put that on hold in May, where we saw how, and we think the correct thing to do, the prudent thing to do, is to keep that on hold until January, when we'll have our interim numbers and have a better picture of how this is panning out. But our intention very much, if things go to plan, is to reinstate that progressive dividend policy in January. But at the moment, we think quite correctly it is deferred. And I'll hand back to Ian.
Thank you, James, for that comprehensive overview. A short word on strategy. Essentially, our strategies are unchanged despite COVID-19. Clearly, COVID-19 has somewhat interrupted the timing, but the strategic objectives that we've stated and have been in the public domain for some time are the same. We intend to build scale in all that we do. Clearly, our focus today is on organic growth. There will be opportunities, I'm sure, as the market evolves, for looking at acquisition opportunities, and we always look at carefully selected acquisition opportunities, but we're in capital preservation mode right now, as you'd expect, and therefore our focus is on organic growth. In terms of other objectives, we want to continue to reduce our cost of borrowing where we can, increase our own book lending, which is happening now. We will be completing a rebranding project in the near future, and we'll announce that when we're able to do so. And we're looking at the possibility of introducing new broking products through additional FCA permissions that we've been granted. And we're continually innovating through using more financial technology and improving our digital capability, and investing in new hires and in management and personnel training and succession, all of which is about delivering operational leverage from the group that we have created, including the ability to cross-sell. So our strategic intent and our strategic aspirations are unchanged, albeit perhaps to some extent interrupted in terms of timing at present, which really leads me on to our summary and an outlook. I mean, 1PM has a strong balance sheet. We're trading from a strong position. We've got robust and resilient policies and characteristics that form part of our business model. We're in a strategically sound market position in our view. We had a pre-COVID track record of delivering against expected financial results, and I think we've responded effectively and intelligently to the business impact of COVID-19 over the past 6 months. So we are now reaping the benefits of that. We're making good progress and returning back to pre-COVID levels of origination. The first quarter of the new financial year has exceeded our own internal operating budget. I mean, there are no market expectations, market guidance in the market at present, but in terms of our internal operating budgets, we've exceeded those. And that has been important and has resulted from staying open for business. And I think that has put us in a very good position competitively. There are some other non-bank lenders in our industry who have not been open for new lending, and we're benefiting from that competitive position. And we, as we've described, we have prudent additional provisions in our balance sheet now to cover the potential impairments that may come as the economy comes out of COVID over the next few months. So when it gets to the interim results in January, we'll reconsider market guidance for the current financial year at that point. And as James mentioned, we'll also reconsider our interim and final dividends that have been postponed for the time being. Our final slide is just simply a snapshot of the shareholders, the main shareholders, the top 10 shareholders as of 31st of May. No substantial differences as of 31st of August. And that concludes the slides that we wanted to talk through today. I hope that's been helpful for all of you. And I'll hand back to Mark now to take us into a question and answer session.
That's very kind, Ian, and thank you, James, very much for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the Q&A that has come in during the live event and ahead of entering into the pre-submitted questions, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately post the presentation ending, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. And we'll be very much encouraging you to do that where it's possible. Ian, James, I guess before we address the questions that have come in through the live event, we had 3 pre-submitted questions. The first of which was, how do you feel you fared against your competitors during COVID-19 in terms of winning new business and retaining existing? And what are you seeing in the new lending and business trends?
Yes, thank you, Mark. So as I mentioned, in terms of competition, we have seen some of our regular competitors not be in quite as strong a position as we found ourselves in providing forbearance to existing customers and managing that through their own cash flows. So those particular businesses have had to ask for forbearance from their funders and therefore have been unable to lend for new business. So we've fared well in comparison with some of those businesses that have been unable to lend. And of course, by adding the CBILS product to our portfolio of origination channels, we've been able to have the benefit of those additional loans as well. So we fared well, in particular in relation to our competitors in that respect. What I would also point to is, as evidenced by a couple of Google reviews, we've actually had some very strong reviews from customers around how we have dealt with them in terms of providing forbearance and looking at their individual circumstances. So to that extent, I think the market has perceived us as being a helpful customer-led lender, which, as I said right at the start of the presentation, is very important to us. In terms of new lending, I mean, there have been some quality issues out there in terms of some companies. I think James used the expression of chancing their arm about funding under the government schemes and coming to us, for example, for CBILS loans. We've very much held our credit policy in place, and therefore we continue to lend what we think is high quality and high margin business.
Thank you very much. I think you touched on the next question through the presentation, but just for whether you could expand slightly, do you expect bad debt to increase post-government support schemes scaling back?
Yeah, I'll take that one if that's okay. Okay, Mark. Yes, I think we did touch on it, and but I'll add a bit of flavour now. And also, I saw one of the questions that's popped up on the Q&A tab from Paul is about the provisioning levels as well. So hopefully, I can kill two birds with one stone here. Yeah, so we increased our bad debt provision, as we said, to 5.1 million. We feel we have been cautious, prudent there, and what we have done deliberately is we have looked forward. Excuse me. We have looked forward to potentially some of the government support schemes being pulled, and what that could do to our book, and we think we factored that into our prudent and cautious bad debt provisioning level. So we do not expect any material increase in our bad debt provision this financial year. We think we've effectively factored that into our numbers as of the 31st of May. And we think we've, I mean, you never know, but we think we factored in a potential a downside there. And so we would expect our bad debt provision not to increase materially at all.
Thank you very much. And just finally, do you see scope to reduce your overall cost base?
I'll take this one again, if that's okay, Mark. Yes, so we've made a conscious decision. The answer, sorry, is a yes and a no. The yes is we did, as I touched on, we did take out a number of staff costs towards the end of the financial year under review. On a run rate basis, that's about £750,000 we'll have saved on our cost base in the current financial year. But we didn't go further than that, and that was deliberate because our view is we didn't want to cut our nose off to spite our face. We very much feel that we will return to pre-COVID levels and hopefully beyond. And so what we didn't want to do is make wholesale redundancies for say 6 or 9 months and then have to go and rehire people like that or the same people again. We felt that was the wrong thing to do. We want the business here primed and ready for growth. And we think over Q1, where we're seeing a real increase in origination, we think that validates the decision we've made. So yes, we have taken best part of £750,000 out on a run rate basis, but we haven't gone any further than that because we feel that would be a very short-term decision to have made.
Thank you very much indeed. Well, that completes the pre-submitted questions. So if I could ask you just to click on the Q&A tab so you can see the questions that have been submitted by investors. And I know I haven't given you an awful lot of time, but perhaps if you could start at the top and where appropriate, if I could ask you to read out the question, perhaps even who it's from, and then give your response where that's appropriate. Thanks ever so much.
Yeah, thank you very much, Mark. I mean, there are some, I think, very valid and important questions here for us to address. So we will attempt to address all that are there in the time that we have available. So firstly, from John B, can I please ask what is being done to address the 75% decline in the share price over the last 5 years? Pre-COVID-19, the company has been unable to generate shareholder value, and this has been reflected in the lower share price. Yeah, so I think my comments on that, John, are that we're here to run the business and manage the business as best we can, and we have delivered our numbers over the past 5 years. And to a great extent, the share price decline has been outside our control. That said, what can we do about it? I mean, clearly we've spent a lot of time talking to non-shareholding institutional investors through our a nomad and broker over the last few years. We are continually looking at strategic opportunities to see if we can unlock the valuation problem that we perceive we've had over the last few years. We've looked at various tools like the introduction of the progressive dividend policy and a share buyback program. And we're constantly challenging our advisors to help us with addressing the share decline issue. I have to say that we're not any different really to many other companies in this financial services sector. There is a sentiment problem that we're all having to deal with. But fundamentally, our job is to deliver the numbers, and we've continued to do that. So that's the primary objective. But of course, anything that we can do to try and improve the shareholder returns, we will be focused on as we come out of this COVID period. And I think that leads on to the second question from John B. What will 1PM do to return value to shareholders? Assuming the business improves, will 1PM prioritise generating value to shareholders instead of pursuing equity-funded acquisitions, brackets, that have historically severely diluted shareholder return? Well, I think the answer is yes. I mean, clearly right now we're in capital preservation mode and we're focusing on organic growth, and we want to do that in order to increase shareholder value. Now is not the right time to be issuing shares to fund acquisitions. I totally agree with that. The only point I'd make about this dilution in the past is that all of our acquisitions have proved to have been successful and are generating profitable business now. So it is the overall sentiment issue around the valuation of the business that has caused the decline in the value of the shares, not the dilution in my view. A question from Mark S. The company is trading at 0.5 tangible book value despite conservative bad debt provision on the balance sheet, and historically has traded at a premium to tangible book value due to high profitability. This leaves the company open to a bid. What bid defence has the company put in place to avoid being bought out at a low point for the business? Well, it's a very good question, and something obviously that we're mindful of. The bid defence that we have is that we have 3 shareholders, and I think the shareholder slide is still up on your screens. 3 shareholders own more than 50% of the business, and I know that all 3 of them would not sell to an opportunistic bid at a ridiculously low price. So my most readily available bid defence mechanism that I have is the shareholders in the business who understand the potential value of this business and would not, I believe, sell shares to an opportunistic bidder. And a further question from Mark in relation to Wellesley Finance that have taken just short of 20% of the equity of the business. And if you see the shareholder slide there, Cloverleaf 374 Limited is a ring-fenced subsidiary within Wellesley Finance. Have we had contact with Wellesley, and have those discussions been constructive with regard to future of the business? Yes and yes. We have had some contact with Wellesley. They're not an insider, so they don't have any privileged information. But they are in the lending industry. They are a strategic investor in the sense that they want to help us grow our business, and the discussions have been constructive. An operational question from Paul L. Why have loans divisions given low profitability? Is there a strategic vision as to why it is, or can be more important to profit before tax? Yes, the strategic vision for loans is that we want to grow and scale our own book loans business in order for it to become more on a par with the size of our asset finance division and our invoice finance division, so that we can generally become a player in asset-backed lending, so providing a range of combined facilities for asset, loan and invoice finance for small businesses. It is important to increase our loans division scale, and we have some plans and some opportunities to consider in order to do that over the next 12 to 18 months as the market and economic conditions allow. Further question from Paul was in relation to the provisioning, which I think James has covered in his earlier answer. So I think that question's covered off. Thank you, Paul. In relation to the share price, again from Mark S. The share price is at, I think that means multi-year low. The directors don't currently have large holdings in the company, and the company is guiding a positive and prudent future. If this is the case, why aren't directors investing their own cash into the equity? Well, apologies for being a little bit blunt and perhaps a little bit glib here, but I mean, we are employees, we're not investors. and we are very rarely in a position, frankly, where we can buy shares because of being insiders, obviously, and having price-sensitive information. We've just released our full-year results, so that's the end of our closed period. But there are other activities that we are considering that effectively mean that we are in a position where we should not be trading shares. So we are rarely in a position where we can invest. All that said, I believe, as you say, we are guiding a positive and prudent future. And when the opportunity arises for directors to consider acquiring shares, I'm sure we will do so. Moving on, John B. Why does 1PM not track against market expectations? Shareholders are not aware of management expectations, so it is fairly easy to beat management expectations. Well, I fully understand your point there. There are no market expectations in the market at present, so I'm not sure where you might be referring to in terms of market guidance. There isn't any, certainly nothing official. Senkos are our broker, and they've not provided any market guidance. But I take your point. It isn't helpful necessarily for directors and management teams just to say we're tracking to management expectations. As I say, when it comes to the half-year results, we will reassess whether we can provide clear market expectations for profitability for the current financial year. A further question from Paul. When will we get details of the new executive remuneration scheme, and what can you tell us about objectives and structure now? I can't tell you anything about objectives and structure now. The remuneration committee is actively considering what the terms of the new scheme should be, and considering in conjunction with shareholders in the form of, in particular, our non-executive director, Ron Russell, who is obviously a large shareholder, so has an interesting say in this matter. So it's under active consideration, and we'll announce the details as and when they become finalised. And from Alan V, is there any intention to buy back 1PM shares? We do have an agreed share buyback scheme, and we have an employee benefit trust that is from time to time acquiring shares in the market. So that is happening. And then I think it's the final question from Michael S. Explaining the net asset value further, I think to explain the investment case to future investors, you should flesh out the breakout of the acquired businesses from 2015 to 2017 and how they, presume that means how they've contributed to the P&L since they were acquired. Good point. I think the segmental analysis that we're providing does effectively provide that, in the sense that, for example, the invoice finance division does constitute two companies that were acquired in 2017. So we can see the separate performance of that particular division. And yes, we as we always do, we confirm the position of the acquired companies, and they are all profitable and trading effectively as we thought when we bought the companies. All of the businesses that we acquired that had earn-out arrangements, the earn-out arrangements have all completed and they have all been achieved. So the acquisitions have fared very well since acquisition. But point taken on continuing to explain to investors that is the case.
That's brilliant. Thank you very much. I think that is, as you said, that's taken care of literally all the questions that have come through on the live chat. But perhaps, Ian, I could just ask you to wrap up, and I know feedback, we're coming up to the hour as well, so perfect timing. But perhaps I could then direct, because I know that investor feedback's important to you, but if I could ask you to wrap up, that'd be great.
Thank you very much. Well, I'd say I appreciate the opportunity to go our results in terms of the investor and shareholder perspective. Clearly, we think we represent incredibly good value in terms of trading at a discount to our tangible net asset value. But our job is to make sure we continue to deliver results from a robust and resilient platform, and to trade through the current economic uncertainties. And that's our intention for the course of this current financial year. And we'll keep everybody updated as and when we're able to.
Perfect. Thank you very much. Thank you, Ian. Thank you, James, for updating investors today. And sorry, Ian, I managed to mute you instead of myself just as you created the wrap up. But thanks once again for the presentation today. Could I ask investors please not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, the feedback page will appear. Alternatively, if you came in through the link in the email, you'll be asked to log back in to provide feedback. It would be very good if you could do that for us. On behalf of the management team at 1PM and Investor Meet Company, I'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to everyone. Thank you.